Morning, and many thanks for joining this morning's briefing on the Provisional National Accounts and International Accounts results for Q1 2023. We'll have time to take questions at the end of today's presentations, and can I ask people to use the chat function for questions or to raise your hand if you would like to come off mute to ask a question, and we'll manage that. Look, we have the results here today for Q1 2023. The results are showing a contraction in GDP in the quarter, driven by an overall contraction in the multinational dominated sectors. This morning's briefing will take us through the detail and the breakdowns to help us to see the impact of this M&A activity on the result and to understand what's happening in the underlying domestic economy as well. As we always point out at around this time of the year, these are provisional results. The annual national accounts results will give a more definitive picture when they're published in the coming weeks. So slides from the briefing will be available with the CSO publications on our website, and we'll try to make a recording of the presentation today available on our YouTube channel. I always like to stress that the contact details are available on the statistical publications and on our press release, so please contact any of the subject matter experts at any stage with queries you might have. So I'll pass to Chris and John now to take us through the results for national accounts and then for the international accounts. Many thanks, Chris.
Thanks, Jennifer. So I have the results for Q1 2023 for the national accounts, and our headline figure here is GDP down 4.6%. This is the main driving factor here is industry. The industry results down over 18%, while the M&E sector, information and communications, growing 4%. The big domestic sector, distribution, transport, hotels and restaurants, that's up 2.7%. And another important domestic sector, construction, is up 12%. So we have that mixed picture from the domestic sectors with little growth overall, and the big M&E sector, industry, down substantially in the quarter with considerable volatility there, perhaps in the cost data over what we came out with 30 days ago. Looking at the expenditure side of the accounts, on the bottom of the infographic, consumption on goods and services is up 1.7%. Government spending's down 3.5%. Exports and imports are both down marginally, but I guess the determining factor on that side is investment, down 12.7%. When we take out the effective intangibles and look at the modified investment numbers, that's up substantially. I'll talk about that a little bit later, but that increase in investment, the modified investment, is what's driving modified domestic demand, which is on the bottom left-hand corner of the infographic, up 2.7%. So there are two headlines really for the quarter: GDP down 4.6% and modified domestic demand up 2.7%. If we look at both of those across time, we'll see the history of the GDP data, usually quite positive. With the revision this quarter, Q4 has now gone marginally negative from 0.3 to minus 0.1, so you have two negative quarters of growth. And I'll put a caution on that. We'll be back again in a month's time with another version of Q1. So that Q4 number is very, very close to zero. But that GDP negative in the quarter is the information on GDP. And then for MDD, we had two negative quarters of MDD in Q3 and Q4, with a strong positive result now in Q1 2023. I mentioned the flash, or the preliminary estimate, that we produced 30 days ago. So when the quarter finishes, 30 days later we come out with this flash estimate of GDP, and it was minus 2.7%. With 30 more days to today, our T60 estimate as a result of 4.6%. So what's different? Well, we get more information on costs, and particularly the effect this quarter was costs in industry, increased costs, reducing the output or value added for industry. And we obviously have the expenditure method as well. So the early estimate, the flash, is based on output, and we've two methods for the T60. And that's the explaining factors, I guess, for the difference in the more negative GDP growth rate today. If we put that minus 4.6% in context from some available European peers, we're on the far left. So we're usually on the far left, or I guess the far right on this chart. But today, the negative growth rate puts us there with a lower rate than Lithuania and the Netherlands, while at the other end we have Poland, Luxembourg and Portugal with strong growth rates in GDP on a seasonally adjusted basis. How does the industry result of minus 18% affect GDP? Well, it's that big block on the far left-hand side there, the blue block, that is the industry contribution to GDP. And because it's so large, that minus 18% is where we get the minus 4.6% effect overall on GDP. The next large block is information and communications, another big M&E sector in green there, and that's got positive results of 4%. And getting smaller blocks. So there's more information on this slide. Public admin, education, health, and real estate wasn't on the infographic. They're both showing some small growth, again, to important kind of domestic sectors. If we look at these across time, which each quarter I encourage you to do, to go onto the website, pick up the graphic and toggle on and off the sectors, you can see the context, I guess, for that industry result. So down in Q1 2023, while we have that growth in information and communication and the growth, or the smaller changes, I guess, in the two big domestic sectors, distribution, transport, hotels and restaurants, as well as construction. To look at industry in a bit more detail, we can see some of the CSO high frequency data with our industrial production and turnover index. That was published on the 9th of May, and that showed us this large decline in industry in March. So that's the kind of explaining factor that we have in terms of the high frequency data for what's going on with industry. We can look as well at the monthly services index from CSO and see where the services data has been going over the quarter, and that gives us kind of a mixed picture across the different sectors, wholesale and retail and transport, starting out strong in January and then with some falls, I guess, in the later months. That's what gives us the overall small increase in services. So weighing up both sides, the M&E dominated data with a fall of 15.7%, and then the domestic or the other sectors with growth of 2.7%. That's how we can weigh up the output side of the accounts. Small positive growth for the domestic sectors and a large fall in the M&E data for the quarter. We have data from our income method. Right? One of the parts of the income method, we have this quarterly compensation of employees, or the wage bill, and there's important information there too. So wages are up 1.4% in the quarter. That's quarter on quarter seasonally adjusted, real wage growth of 1.4%. The big sector, public admin, education and health, up 3%, and strong growth as well in professional admin and support services. We also have the new analysis on the wage bill with the M&E, non-M&E contribution to the economy. So again, the wage bill is the big important domestic part of the data. On the income side, the other element is obviously profits. And we've increases here in Q1. So this is current prices, so the share is really what we're looking at here. But we usually see a Q1 effect from M&Es with bonus payments in Q1. But nevertheless, it's risen up to a share of 37% of the wage bill. So 37% of wages in Ireland are being paid by foreign-owned or multinational firms. Then moving to the expenditure side of the accounts. So we build this up with consumption on goods and services, government consumption, investment, and trade or net exports to get the GDP result. And we can strip away the foreign element to leave us with the blue line there in the middle, modified domestic demand, which is up 2.7%. The interesting bit that we haven't looked at, I guess, is the modified investment to get us up to modified domestic demand. So it's consumption by U&I goods and services, government consumption in green there, and then the new bit then is modified investment. And there's considerable growth in that. We've been watching machinery and equipment over the last 5 quarters, the back to office equipment spend, that's largely fading out now, and the dominant feature there is M&E's spending on plant and equipment in Ireland, and that's particularly in the pharma sector or in the ICT sector on data centres. So that equipment spend has increased, but we also have a key feature there on modified investment on dwellings. So building and construction is also up quite strongly in the quarter. Putting all those together gets that 2.7% result for the modified domestic demand measure. Looking at the individual elements there then, consumption on goods and services is up 1.7%, goods up 2.7%, largely in line with retail sales, and services up 1.1%. It's the driving factors here are probably cars, a very positive result in terms of consumption on vehicles and cars, and then the continued increases in foreign travel, return to foreign travel driving consumption. If we look at slightly different measures, so the European equivalent of our personal consumption is household consumption. And if we put Ireland's data in that context with other European peers that are available today, we appear on the far right, just next to Luxembourg. So in terms of household consumption, we're on the far right with Latvia, Spain, Germany, Sweden, for example, on the left, with declines in household consumption. The price element, I trying to stress this now over the last couple of quarters, be very mindful of prices in terms of interpreting data. We show you real GDP, real consumption, the volume indices, but the current price data shows substantial growth. And that widening gap on the chart is just to illustrate that to you, so that we're spending more and more on the blue line, but what we're getting in terms of volume is represented on the green line there, showing growth of 1.7% in the quarter. What did our high frequency data and retail sales tell us? Well, that was showing us that overall consumption over the months of the quarter showed a small positive, with a mixed picture, I guess. Again, strong starts in January for furniture and for clothes, and then some falls in some of the later months. The second element on the expenditure side is investment or capital formation. That's down in the quarter, but again, we strip out intangibles. We can see below this what's going on. Building and construction is up 8.7%. So that's the dwellings data that we see increasing in dwellings and commercial construction. And then machinery and equipment up 11.6%. But when we take aircraft out of that, there's a couple of lines down there, we see growth of 16%. So again, the key feature on that is the spending by M&Es, probably on plant, we call it plant and equipment inside mainly the pharma companies and data centers for the ICT companies. So for capital formation, we've got both those driving features: building and construction up, dwellings, commercial building, and then machinery and equipment. And both those things, those domestic factors, are explaining the growth of 2.7% in MTT. You can look at those again across time. If you go into the publication, you can toggle on and off the different series to turn off perhaps intangibles and look at the other features over time. And the last item is, to finish off the expenditure method, is trade or net exports. In seasonally adjusted constant prices, we have a small decline in both imports and in exports, with the trade balance largely unchanged. But I'll leave that to my colleague John Sheridan to. He's got much greater detail on the trade data from the international accounts. So weighing up all the items on the expenditure side of GDP, we can see the minus 4.6% growth rate decomposed into the MDD or modified domestic demand element and the net exports element, obviously with the foreign side of the net exports element driving the change in GDP. After GDP, then, we take out the what's largely foreign profits or net factor flows at 33.9 billion, and that's what gives us our GNP figure. So GNP and GDP both showing a decline in the quarter because of this volatile M&E activity. And then before I finish up, just to take a step back and look at, many of you asked this question of, okay, not just the quarter, but how are we compared to the same period a year ago? To look over a little bit of a longer period of time. GDP's largely flat at minus 0.2% over Q1 2022. GNP's down 4.2%, but modified domestic demand is up 5.5%. So the cumulative effect of the data since Q1 22, looking at today's quarter versus the same quarter last year, is up 5.5%. If we do the same thing for prices, what's going on with prices? How are prices affecting our data? We have two examples, one for GDP and one for consumption. So to interpret these, we'd say that over the same period last year, so we're looking at annual rates of change. It's the easiest way to look at prices. The annual rate of change, GDP, is up in money terms 4.7%, but in constant prices or real GDP, we're up 0.2%. Sorry, down 0.2%. So that gives us a difference or an implied deflator of about 5% for GDP. And then consumption of goods and services, which is a little easier to understand for everybody, that's up in money terms 13%. So we're spending 13% more on goods and services, but we're getting 6.4% in terms of volume for what we call constant prices, again giving us an implied deflator of 6.2%, the difference between the amount of money spent and the volume measure. So prices are important. I guess that's the the message on that, and we're trying to interpret the data. So just to sum up, GDP is down 4.6% because of the volatile industry data we have at minus 18% there. But then we've got growth in construction up 12%, and the big domestic sector, distribution, transport, hotels and restaurants up 2.7%. Weighing all the sectors up, the M&E dominated data is down 15.7%, and the domestic facing sectors are up 2.7%. On the expenditure side, the modified measure there is also up, coincidentally 2.7% modified domestic demand, and the driving features for that up the column on the right hand side are PCE consumption up 1.7%, government down 3.5%, modified investment up 11.1%, and they all lead to, adding those up gets you the modified domestic demand result. With profit outflows, you get the GMP result down 8%, and then we've included on the bottom of the slide compensation of employees or wages. So that's an element from our income method, and that's up 1.4% to kind of add to the suite of domestic indicators. So at this point, I'll pass you over to my colleague, John Sheridan, who will take you through the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts for Q1 2023. So first we take a look at our infographic, which gives a really good summary of the results. So we have our goods exports of 89 billion and imports of 33 billion, giving us our goods balance of 56.1 billion. Our services exports of 83 billion and imports of 85 billion, giving us our services balance of minus 1.5. Our income inflows of 49 billion and outflows of 89 billion, giving us our net income outflows of 40.8 billion. And these all combine to give us a current account balance of 13.8 billion euros, or 11.2% of GDP. Our net international investment position at the end of March was minus 557 billion euros, and our stock of foreign direct investment in Ireland was 1.3 trillion euros. Looking at our headline figure, which is the current account balance as a percentage of GDP, we can see without large IP imports this quarter, we're back to a more stable time series, unlike quarters like Q4 20 and Q4 21. So this quarter we have our current account balance of 13.8 billion euros, or 11.2% of GDP. Looking at that a little more closely, our merchandise surplus of 56.1 billion is up 8.3 billion on the same quarter last year, and our services balance of minus 1.5 billion is down 6.9 billion on the same quarter last year. Our net income outflows have increased by 4.6 billion to 40.8 billion, and these all combine to give us our current account balance of 13.8 billion, which is down 3.2 billion on the same quarter last year. Looking at this balance over time, we can see the quarters with the large negative green bar there, which signifies the services balance, and we can see where these are large IP imports, in particular in Q1 20 and Q4 20 and so on. And we do have a negative services balance this quarter, but it's not being driven by IP imports. So looking at this quarter compared to last quarter, our merchandise balance is up by 2.1 billion, our services balance is up by 5.2 billion, and our net income outflows are up by 9.3 billion. And these all combine to give us a current account balance that's down 2 billion on last quarter. Looking at how this breaks into exports and imports, we have our merchandise exports of 88.8 billion, which are up 10.3 billion on last year, and imports of 32.7 billion, which are up 2 billion on last year. And these combine to give us the increase in net exports of 8.3 billion. Our services exports are 83.3 billion, up 5.3 billion on last year, and our services imports are 84.8 billion, up 12.3 billion on last year. And these combine to give our change in services balance of minus 6.9 billion. And our net primary income inflows are 46.4 billion, up 14.7 billion on last year, and the outflows are 85.9 billion, up 19.3 billion on last year. Within these, our direct investment, profit and interest inflows are up 1.8 billion and outflows up 5.3 billion, with the rest of the increases being driven by portfolio investment income and other investment income. Looking at our goods imports and exports, we can see that for our Q1 goods exports are down compared to last quarter, but up compared to last year. And we see a similar pattern with imports, which are also down compared to last quarter and up compared to last year. But with the increase in exports stronger, the increase in net merchandise year on year is driven by the increase in exports. And it's important to say that these figures are current price, so they will be different to what Chris showed in the decline in merchandise exports, or the net exports. Looking at how that breaks down into international trade, goods for processing and other, we can see that our international trade exports are up 1.4 billion on last quarter and down 1.6 billion on last year, while our goods for processing exports are down 9.7 billion on last quarter, but up 16.4 billion on last year. Merchanting, which is a net export, is up 1 billion on last quarter and down 3.3 billion on last year. Our international trade imports are down 2.6 billion on last quarter and up 3.9 billion on last year, while our goods for processing imports are down 2.6 billion on last quarter and up 3.9 billion on last year. And if we look at the quarterly change, the reduction in exports is being driven by this decrease in goods for processing exports. Looking at our service imports and exports, on the export side, we can see that year on year we have an overall increase of 5.3 billion. And within that, we have an increase of computer services of 3.8 billion. Business services are down 1.1 billion, and operational leasing is almost flat. Tourism services are up 746 million, and transport services are up 824 million, again showing the continuing recovery in these sectors. While if we look at the breakdown of service imports, we can see an overall increase of 12.3 billion, with business services up 1.5, of which R&D is down 446 million, and miscellaneous business services are up by 2 billion, and with a royalties increase of 8.2 billion on the same quarter last year. Tourism services are up 1.4 billion, again showing the recovery in this sector. So we can see that the increase in imports is largely driven by the increase in royalty imports compared to last year. Looking at these royalties a little more closely, on this graph we can see the blue line gives us the total royalty imports, while the green bar gives us the amount of royalty imports related to the pharmaceutical sector. And most of the difference between the two is related to the ICT sector. So for pharmaceuticals, we can see a decrease compared to last quarter of 5.2 billion, but an increase compared to last year of 2 billion. And overall, we can see a similar pattern, with a decrease compared to last quarter of 4.3 billion and an increase compared to last year of 8.2 billion. So we can see that the overall increase is larger than the pharma increase, meaning that the non-pharma royalty imports have also increased. Looking at direct investment income, we have inflows of 11 billion, which is up 2.4 billion on the same quarter last year, and outflows of 48.6 billion, up 6.3 billion on the same quarter last year. And these combined give us the increase in net direct investment income outflows of 3.9 billion compared to last year. Looking at it quarter on quarter, we can see our inflows are down 3.2 billion, while our outflows are up 7.3 billion, in a similar fashion to the Q1 pattern in previous years. And these combined give us an increase in net direct investment income outflows of 10.8 billion compared to last quarter, giving us our overall net outflows of 37.6 billion. Looking at how these outflows break out, we can see that the income on debt is fairly flat as usual. We can see a large increase in dividends, but this is quite common in Q1. But with a smaller increase in direct investment outflows, this results in negative reinvested earnings this quarter. And looking at how these outflows break down by sector, we can see that compared to last quarter, there's an increase in the manufacturing sector, which is up 7.3 billion. And again, this is in a similar pattern to what we see in Q1 in most years. And there's been a decrease in the information and communication sector, which is down 371 million. Looking at it compared to last year, we have an increase of 1.9 billion in the manufacturing sector and an increase in the information and communication sector of 3 billion euros. Looking at our current account with the UK, the trade balance with the UK has decreased by 535 million and net income outflows have increased by 3.3 billion compared to the first quarter of 22. And the result is a current account deficit of 4.2 billion in the first quarter of 23, down 3.8 billion from the deficit of 388 million in the first quarter of 22. Looking at our financial accounts, we see again relatively large net transactions in different functional categories. Direct investment abroad has increased by 9.8 billion, while direct investment in Ireland has increased by 1.9 billion, giving a net increase in direct investments of 7.9 billion. We have a net decrease in portfolio investments of 27.2 billion and a net increase in other investments of 29.3 billion. Our net international investment position stands at minus 557 billion at the end of March 23, which is an increase of 50 billion on the end of December. And this change is predominantly being driven by changes in non-financial corporations. So to summarise, we have a current account balance in Q1 23 of 13.8 billion or 11.2% of GDP. We have an increased merchandise balance, decreased services balance and increased income outflows. And we continue to see the COVID effects lessening with tourism, transport, exports and imports coming back to more usual levels. So now I'd like to pass back to Jennifer to summarise.
And many thanks to John and to Chris for taking us through today's results. So just to pull out some of the headline results from what we presented this morning, some of the key indicators, and these are at constant price, or real indicators and seasonally adjusted. So we're showing a contraction of 4.6% for GDP in the quarter compared to quarter 4 2022. GDP, as we always say, is a whole of economy indicator. And what's driving that is the M&E dominated sectors, the overall contraction there of 15.7%. And that's driven largely actually by the contraction in the industry sector. If we look then take that domestic